Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about a situation that we've come into a whole lot lately. And I think a lot of you are either bumping up against this or will bump up against this in the first year or two of retirement. So I've always talked about that transition to retirement is a very difficult one.
Entering into retirement is 95% mental, psychological, and it's 5% financial.
But within that, there's a piece that really throws people off, and that's the tax situation. Because when you work, you have one job, most of you, and you have employment income. And when you get your paycheck, they've taken off the right amount of tax. When you hit retirement, you have many income streams. There could be CPP, QPP, OAS, RRSP, LIRAs, pensions. There's a bunch of different things. And let me tell you, no one takes off the right amount of tax. And in fact, a lot of times we're taking off too much tax. And that's what we've run into lately. So I want to jump into the client scenario here. And this is, Mr. and Mrs. YouTube, and they are a 65-year-old couple. 2022, they've retired now, and they're going to start drawing out an income. Both of them have $300,000 of RRSP savings and $100,000 of TFSA money each. They wanted to have the projection run until 90. We've delayed their CPP, started OAS now, and you can see we've run an income of $69,562. So that's their total after tax adjusted for inflation income. If we look at Mr. YouTube, you can see here, so he has his RSP here in the middle and his TFSA. What I want to focus on here is this right here. And we've built out a plan where he needs to take $30,000 out gross of his RSP in 2022, along with a very small amount out of his TFSA. So we meet with, Mr. YouTube, and we say, look, you need to convert your RSP to a RRIF and start drawing out this income. Now, this all sounds great and lovely. So $30,000 divided by 12, we're gonna take out $2,500 every single month. Now, the problem is because he converted his RSP to a RRIF in 2022, after we've done the plan, there's no minimum amount on that RRIF from the previous year. So every dollar that he pulls out in the first year, there's going to be withholding tax. And because he's taking out more than $15,000, there's a 30% withholding tax. Now, withholding tax is just money that's withheld. When he files his taxes, he'll get some of it back. But of course, if CRA is withholding 30%, that may affect cash flow, how much cash you'll actually have in your pocket. So if we go back to the plan here, you'll see he has this $30,000 that we're gonna pull out. So if we think about this, if they're gonna hold back 30% of that, that's $9,000 in the year. But we have this tax column here, right in the middle. If we look at that tax column, you can see his tax payable in 2022 should only be $4,529. So he's only going to have $21,000 of actual income to live off of. So that means that come tax time, he's going to get a tax refund of $4,500, which is great on the surface, but it's given him less money on a monthly budget to live off of. If we look at tax rates, when we build out financial plans, one of the key things we look at is your effective tax rate or your average tax rate. And the better we can level that off, the least amount of tax you're gonna pay through retirement. And as you can see here, if you look at effective tax rate, it's about 10 to 12%, 12%, 11, yet he's having 30% tax withheld at source on that RRIF withdrawal. How do we make up for that? What's the solution to this? Well, in this case, I would tell the client, look, we have this TFSA. So instead of pulling $1,700 out of your TFSA, let's pull an extra $4,500 out of the TFSA to meet that cash flow need. And then again, add $4,500 onto here from withdrawal. And then when you get your tax refund here, we're gonna put that back into your TFSA to pay it back. We don't wanna take too much out of your TFSA and not pay it back because that disrupts the plan. So that's year one. Now I wanna look at year two. So let's jump into year two because it's gonna work a bit different. It's that first year retirement that's a bit wonky, and then it levels itself out. So let's go through that. So in year two of retirement, we're looking at roughly the same income. We've jumped it up a bit with inflation at a couple percent. Again, we have OAS, we have 30,000 from the RSP, and this year we have a little bit more from the TFSA to adjust up for that inflation. But again, we're gonna have some withholding tax here. Now, in the second year of RRIF, because we converted to a RRIF in 2022, at the end of 2022, it's going to take the account value at the end of the year, and that's what your RRIF minimum is going to be based off for 2023. So at the end of the year, this client, if we jump back into the plan, this is end of year value, $283,500. So that is going to be what the RRIF payment is going to be based off, the minimum RRIF payment. Now, if you recall from previous videos, the minimum RRIF payment, there is no withholding tax on that. So the year that you're 66, the RRIF minimum is 4.17%. So if we take that $283,500 times it by 4.17%, it leaves us with $11,800. So Mr. YouTube has to take out $11,800. Of course, we want to take out $30,000. There is no withholding tax on the minimum amount of withdrawal. There's still taxes. It's still part of your taxable income. There's just no withholding tax. So that leaves us with some withholding tax. Now, of course, you take 30,000, what we're going to take out, minus 11,800. And because that number is bigger than 15,000, there's a 30% withholding tax. So from 0 to 5,000 is a 10% withholding tax. $5,001 to 15,000 is 20%. And above 15,000, that's going to be a 30% withholding tax. Okay, so in this situation, if the minimum's 11,800 and the client was only taking out 15,000 for the year, there'd only be a 10% withholding tax on the extra amount. So it's going to be 30,000 minus 11,800, and that is going to give us $18,200. We times that by 30%, and there's going to be withholding tax of $5,460. As we can see, that year, there's about $4,400 of taxes, which means that he's going to get a tax refund, all things being equal, of $1,000. So much closer to what it should actually be. Again, and that will kind of roll forward every single year. That RRIF minimum is going to go up. There's going to be less withholding tax. It actually gets better and better as time goes on. But again, that first year of retirement, expect the tax situation to be a little bit wonky. As I was building out this plan on our software, I always play with like the default, which is the default is we put all your information in there and see what the maximum amount of income that could be generated. And in this case, it came out with an income of $69,383. Then when I did the RRSP Meltdown, which is a lot of the tax strategy we use behind it, it came out with roughly the same income, $69,562. So what I want to look at here was I want to show you guys the tax difference, okay? So again, this is kind of the default mode. So Mr. YouTube, you can see his RRSP here, maybe a bit more than the minimum coming out, a little bit of the TFSA. If we click on here, this is your total tax. So combined total tax. So Mr. and Mrs. YouTube from 65 to 90 are gonna pay $270,000 of tax. If we jump over to the second scenario, which is the RRSP Meltdown, if we look at how much tax they're gonna pay, we go from $270,000 to $191,000, okay? Almost $80,000 of tax savings within this plan. And it's typically just how and how much and when you pull out of your registered accounts. And that small detail makes a massive difference. It's not just creating the plan and understanding withholding tax and how much tax, it's also how do we pay the least amount of tax. And putting a proper plan together will do that for you. The last part of this I just want to touch on is the laddered income. A lot of you ask about the ladder. So the go-go, the slow-go, the no-go phase of retirement. I think it's so important. I just want to highlight the numbers in here that I just want to briefly talk about in this video as well. This is the same thing as RRSP Meltdown. So instead of $69,500 level through retirement, you can see here we bumped it up from 65 to 75,000. Then we've gone from 75,000 down to 65,000 at 75. So the next 10 years run at 65 and then 60. The concept's the same here. We have not changed. If I jump into Mr. YouTube, you'll see his RRSP Meltdown is the same. The tax strategy is the same. It's just we're pulling a bit more out of the TFSA earlier with the knowledge of knowing that he still has enough later. If I go to the tax bill is the exact same, the 191. So the thing with those three phases of retirement, I tell everyone this when we put the plan together, it's giving you more now when you can actually spend it, but with the peace of mind that you have enough later to live the life you want. A lot of us, you hit retirement and you hold your money tight. But I want to give you comfort that you can spend a bit more now, knowing that you have enough later. I think we all fear running out of money or not having enough later, or, I need a care facility or in-home care and I need to be able to have money to afford that. But I think what the plan needs to have is, look, let's build it so you have enough later, but we can give you more now so that you can do those trips and do things that you want to do, because so many people in their 80s have the money and they look back and say, oh, if I knew I had this money, I would have done this earlier. So I don't want that to be you. I want you to know that you can do it earlier with the peace and comfort that you still have enough later on. So I hope this video helped you out. Again, if you're coming up to your first year of retirement, again, the income, the taxes, the structure, it's a bit wonky. It never works perfectly, but enjoy it. Start taking that money out, spending it, enjoy that retirement. You've worked hard to get there. Don't let these kind of nuances disrupt your the enjoyment of your retirement. Hopefully it gives you a clear picture on what to expect, especially in that first year or two of retirement. It won't work smoothly for you, but enjoy it in the meantime. So hopefully it helped. We'll see you in the next video.